I feel like that's the sentiment around here for sure. Hello, everyone. For anyone that just joined, we do have a poll just to get things started. If you go to the chat box, we'd be interested to hear whether you're excited for some more winter or for some spring. Seems like spring is for the most part what people are craving. And if you notice in the box you guys are using, there is a little poll button. So we will be using the polling throughout our session just to kind of keep engagement and gather some information. So please feel free to click over to that and give a vote. I'm with you, Michael and Corey. I'm ready for a little more winter. I haven't gone skiing yet, so. Okay, well, it's 2 o'clock now, so we, I believe, are ready to go ahead and kick things off. Are you all good to go, Devin?
Yep.
Perfect. So thank you all so much for joining. As I said, please go to the poll tab and complete that question. We'll be using that throughout the presentation. But today we will be talking about R&D tax credits in Section 174 expenses or costs and how those two interact under the new TCJA rules and a few ways that we can help optimize the R&D credit to maximize the benefit as well as minimize the costs that need to be capitalized under Section 174. So just for a quick introduction, my name is Savannah Durham. I am an assistant team lead here at Layton. I've been here now for almost 6 years, I believe, and I work primarily in the innovation unit. So that includes the R&D tax credit, the orphan drug tax credit, research grant applications, any kind of really innovation funding. I do have a background in chemical engineering originally, and I'm currently in law school part-time trying to go into intellectual property law. So it's really nice to meet all of you guys.
And Savannah, you're coming up on 5 years. I know that because I'm coming up on 6 years, which is a point of pride. But
Right.
anyways, I'm Devin Medrek. Nice to see everyone. Thanks for attending. Yeah, so Layton, almost 6 years. I manage the accounting and finance personnel on the innovation team. So we're the ones who run the numbers and create the draft forms and quantify the credits and incentives we work on. Primarily in R&D, but a big focus of mine specifically has been those 174 compliance elements, which we'll get into. And I came from PwC before that for a few years. So nice to see everyone.
For a little bit of background on Layton, if any of you guys have not heard of us, we are an international consulting company. We specialize primarily in very niche specialty tax credit and financial strategies. So we also work on, grant applications and a few other services related to tax credits and financing. We have over 50,000 clients worldwide and 25 plus years of experience. And in the United States, we are located in Boston with an office as well in San Francisco. So to speak to our agenda for the day, first we are going to cover the treatment of research costs under IRC Section 174. Some of you guys may be aware that there's been some recent changes. This might be news to some other people, but we're just going to give an overview of how those changes impact any company that is performing research activities. We will then move to the R&D tax credit. So this is a permanent tax credit. Hopefully a lot of you are familiar, and if you're not, you'll get a pretty good overview of how it might be applicable to your business today. After which we'll move into kind of combining those two topics. So we'll demonstrate how Layton optimizes the amortization of research costs under Section 174, and maximizes the R&D tax credit to try to give our clients the best financial benefit for the research that they're performing. Then we'll move to the benefits of claiming the R&D tax credit on an original filing as opposed to waiting to amend. And lastly, touch upon Layton's process and a little overview of some of the other ways that we may be able to help your business.
Okay, so starting with the treatment of research costs, we'll get into it, but this is something that has pertained to R&D and R&D industries in general for the past couple of years. Hopefully you've heard of it as a prospect or, running a company or a CPA. So the background, it's per the Tax Cuts and Jobs Act, or the TCJA for short, this requirement. And it basically says that for research costs, no immediate deduction is allowed. So what does that mean? A little bit more in depth. And this is since tax year 2022, this was in effect. It basically says that regardless of whether a company is claiming the R&D credit, the credit is not affected by this rule, but the treatment and, basically the tax treatment of costs, the R&D costs, need to be capitalized and amortized. Again, tax year 2022 and onward, and prior to this, as probably a lot of people know, you could take your deductions for R&D costs and you could also claim the credit. The only thing you had to do in tax year 2021 and prior was reduce expenses by the amount of the credit, so as not to double count those costs for both a deduction and a credit. But now, this is an example, first of all, the bottom, of what capitalizing and amortizing under this rule, $100,000 in qualified research costs look like. So say you had that amount in 2022, instead of $100,000 deducted on the return, it needs to be 10, 20K, 20K, so on and so forth until the sixth year, the last 10,000 of that cost is amortized. So it's basically expensing or deducting a cost over time, much like you buy a building as a company. You can't take the $1 million cost of a building. It needs to be amortized or depreciated over, 39 years or 37. So similar concept. Amortization is just for quote unquote intangible assets versus depreciation being for tangible. Notable, lastly on this slide, you see US 5-year amortization period, but as you can see, it's really 6 years because you use a mid-year convention at the start and end of the period. Same concept, but 15 years for foreign-based costs. So we would see this mostly in software development firms, for instance, outsourcing some of the development work, overseas contractors, for example. So the treatment of this kind of correlates to the credit in general. It was designed in the late 80s to incentivize US-based research. So this is still kind of doing it in the same way. It's just unfortunate, of course, that the cost can't be immediately deducted. So I would say this is kind of a less known detail about the legislative requirements. The point of this image, first of all, is to portray the fact that usually a bulk of your 174 costs are going to be R&D costs directly attributed to the credit. So Section 41 is the R&D credit code section. In that, the costs that go towards the credit, the research credit, you can think of it as direct research costs, wages, contractor costs, consumable supplies and materials, so no capital equipment costs. And then computer leasing expenses, Microsoft Azure, Google Cloud, whatever it may be, used to facilitate mainly software development. So those are the costs that you get the R&D credit on if they're US based. That doesn't consist of all of the costs that need to be capitalized per this new rule in the TCJA. The other costs that need to be capitalized, at least in portion, in connection with R&D activities, are what you see there. So some of the notable ones: other employer paid employee costs, so like 401k match, portion of each employee's payroll tax paid by the employer, Other things, patent expenses and associated legal costs if they're in conjunction with the R&D activities or products being developed, for example. And then the big overhead items, depreciation on the building if you own it and equipment used in R&D, rent if you don't own your building but you're still using a facility, utilities, gas, electric, water being used in conjunction with R&D. And we mentioned the foreign based that needs to be considered as well. So there's no credit allowed on those, but the total capitalized under Section 174 cost amount will always exceed the total R&D costs. You do need to focus on these other line items as well. So, as you can deduce at this point, this is a matter of compliance, not just claiming a tax credit to save you money at this point. So it's important, if you've never as a company claimed the credit or thought about it, are we kind of intrinsically performing R&D? And this is not a comprehensive list of companies and industries that's very likely to be occurring, but this is a good starting point as a frame of reference. Manufacturing companies, product development, especially with increasing technological advances in the manufacturing space and digitization of your manufacturing process and whatnot. We'll get into the 4-part test and why something like that would be R&D, but the other ones are pretty straightforward. If you're developing pharmaceuticals, new vaccines, new drugs, biotech in general, software development, I've alluded to a couple times, clean energy, you can probably think about it and tell pretty easily, and the 4-part test coming up will help. But if you're performing R&D, regardless of whether you claim the credit, you need to worry about capitalizing these costs at this point.
And just for a little more background, the importance of that, the IRS already is going to have your NICS code. They're already kind of aware of what industry you're in. So it's just important that you maintain compliance. Obviously, if you're in any of these industries it's a necessity that you must be doing some research activity to even operate in the industry. So we'll get into manufacturing specifically, but these are kind of the industries that have very strict compliance requirements with the 174 expenses. Okay, so a quick poll question is up for you guys. We'd like to know if you have been capitalizing your expenses correctly since 2022. Have you heard of this? Really just some feedback on your guys' experience with Section 174. It looks like a lot of you guys have. Oh, sorry, Devin.
Yeah, because we'll leave this up for like 10, 15 more seconds. But one more thing I forgot to mention on that last slide. It's particularly important if you've claimed R&D in the past, and because of this rule just stopped all of a sudden. I'm sure, a lot of people can figure the IRS likes consistency in reporting, essentially. So to the point on the NAICS codes, for instance, that's all doable audit-wise and an IRS review-wise just with AI at this point. And it's similar for the system just to identify, has this company claimed the credit in the past? Have they filed a 6765 in the past? Now, all of a sudden this year, it's not showing up on the return. That's a little sketchy and it's going to be flagged. So just wanted to mention that.
Awesome. Thank you, Devin. So it looks like a lot of you guys have been capitalizing, so that's good news. Hopefully we can give you some insight into how you can, maybe reduce that increased tax liability with the R&D credit. So just as a heads up, any questions, we will leave some time at the end to address, or feel free to put them in the chat box at any point, and either one of us will answer them. Right. So as I mentioned, moving into the R&D tax credit, so obviously governed by Section 41. As you guys already know, it's been around for a very long time. It was made permanent by the PATH Act in 2015, but it's a credit that enables companies to offset income tax liability specifically derived from the business. So there is a payroll option for some small businesses to use the R&D credit to offset the employer portion of the Social Security tax. So if you are within your first 5 years of gross receipts and have less than 5 million in gross receipts for the year you're claiming, you are able to use the R&D credit to offset up to $500,000 in the payroll Social Security expense. The credit can be carried forward for up to 20 years and back 1 year. And a lot of states also have their own version of the R&D tax credit. So as part of Leighton's study in our process, we do calculate both the federal, and then we look into the state you are operating in to see if there may be any state credits to take advantage of. And finally, you can amend for up to 3 years to capture research costs that were expended in those years. And that's just driven by the amendment deadline for any corporate tax return. So the 4-part test that Devin had mentioned earlier, the R&D credit is an activity-based credit, which means the very first step is to evaluate whether your activity meets the 4-part test or the criteria for R&D. And then the second step is to determine which costs we can use in the calculation of the credit. So the 4-part test to determine whether your activities qualify is that there has to be first a new or improved process, product, technique, formula, invention, software, whatever it may be. It doesn't need to be novel to the industry, but it does need to be new to your business. And that's otherwise known as a business component. The next criterion is that the activities that are being qualified need to be technological in nature. So that just means that they need to be rooted in the hard sciences, engineering, biology, chemistry, so on and so forth. We can't include projects associated with like marketing surveys, let's say. Finally, the last 2 criteria, they go hand in hand. So I'll touch on criterion 4 first, which is that there has to be a technical uncertainty present at the beginning of the process. So that may look like, what pressures do we use? What temperatures do we use? What pump speeds do we use? So on and so forth, in order to either improve the efficiency of our process or the quality of our product. And in order to determine those KPIs or eliminate those uncertainties, you have to go through a process of experimentation. And that's that's number 3 here on the slide. So the process of experimentation could be trial batches, water runs, maybe running modeling and simulation, etc. So after we determine the projects that are qualified in a given year, we then look into the expenses that we can associate with those projects. So Devin already touched upon these. I'm going to quickly talk about the personnel involved. So we are able to include the W-2 wage or a contractor for someone who is directly performing research, and someone who is 1 level above that direct performer, otherwise known as directly supervising the research, and anyone that is directly below that direct performer, and that person is directly supporting research. So there's 3 levels of activity with regards to wage and contractors that we're able to include in the analysis. So a few examples throughout this presentation, we've used manufacturing as an industry to kind of exemplify some of these activities and costs. So I'm not going to go through all of these, but these are some great examples of what the IRS would deem as a research activity. So obviously improving the efficiency of your process, any product validation, in lean manufacturing improvements, if you're doing any simulations and design, CAPAs and change controls are big. So those would all be research activities. And if you're performing those, you need to be capitalizing your costs, but you can also receive a credit for those activities. So just by way of example, so you guys can kind of put, some numbers to what we're talking about. here's an example of a manufacturing company that has 34 W-2 employees, about $200,000 in outside costs per year, and about $1 million in consumable supplies. So the R&D credit that we were able to calculate was determined based on about 40% of qualified employee time, so about 40% of their time spent on R&D activities, about 10% of their time for outside services, so contractor expenses, was spent on research activities, and then finally, about 28% of their supply costs were deemed to have went towards R&D activities. That leads to $1.5 million in qualified research expenses and an R&D credit of about $151K for that year. So as you can see, it's a very lucrative tax credit. Obviously I'm a huge fan. I work in the industry, but all right. So now just a quick polling question again. Have you guys been claiming the R&D credit either in the past, or are you guys currently claiming? We would love to know more. So I'll give you guys about 30 to 40 seconds to answer that.
And like Savannah said, we will get to some of the bulkier questions at the end, but just to knock a couple out while we're waiting. If the funds come from SBIR or other federal grants, can you claim it? So I'm assuming that can you claim the credit is the question. The credit section 41 specifically deems that funded research, so that includes like from grant funding, you can't claim the credit on those costs if they're funded from another source, but they do need to be capitalized. So that's not, good news or a happy answer to the question, but hopefully that helps. And then let's see if there's any other quick ones. Whether patent costs and related legal costs need to be capitalized. Yeah, that was addressed in one of the earlier slides. So the credit historically, patents are very indicative of research and development being done. I'm not sure if there would be an example where that wasn't the case if a patent was granted and applied for. So the associated costs, of that patent and the legal fees associated with it, the application process and whatnot, they do need to be capitalized. No credit on that, but yes.
Awesome. Well, it looks like a lot of you guys have been taking advantage of the credit, and there's a few of you guys who haven't taken advantage of it. So I know there's a couple other questions in the chat box, which I will address towards the end of the presentation, or if we have another poll for a few minutes.
Okay, so the credit is obviously very lucrative. Like I said, it's a great program that's been a permanent credit since the late 80s. But this compliance piece and continuing with our manufacturing case study, what does it look like to analyze those other line items that need to be capitalized where you don't get a credit on them? We'll show a couple quick examples. And overall first, how do we do it? Why is a consulting firm like Layton better to do this sort of analysis and whatnot? There's a couple things. One, for this, what I'm about to get into, these other 174 capitalized line items, the IRS has come out, specifically notice 2023-63, and I think a couple subsequent clarification notices, but that specified in detail how you go about capitalizing these other line items. And they basically allow for reasonable and consistent, quote unquote, allocation methods to capitalize a portion of things like rent, depreciation, all those things I mentioned. So it's important just to note, like, the tax landscape is ever changing. CPAs are just inevitably not going to be up to date on all these notices and tax code changes, especially for niche credits and deductions. People might have experienced kind of the shortage of CPA labor in general. Maybe one or two companies here have been dropped by CPA in the past. So they're trying to stay within compliance, yes, but this is a pretty new development. And the point is that we as a company peruse these notices, make sure we're optimizing things for clients and stay up to date on all the rule changes. on an ongoing basis. So that's one thing. We'll get into a little bit. The more granular the approach, the more detailed the analysis, the more optimized what's going to be capitalized is. And on the credit front, a big selling point for us is just that we have technical experts. You know, Savannah's a chemical engineer, for instance, but we used to have dentists on staff. We have oncology, software engineers, architects, you know, studies majors and whatnot. So technically, we probably understand the work better than a lot of CPAs or bookkeepers would, which lend itself to maximizing the credit, usually identifying all of the possible technical qualified projects and maximizing that credit while making sure the capitalized amount is in compliance. But for most companies, they're going to want it as low as possible. So those are a few points on this one. And we do offer in-house audit defense. We have our head of tax, who's an attorney who's been defending R&D claims for 4 decades at this point. Anything to add, Savannah? Okay. So the case study, 2 slides here. This is an example of how we use the IRS's guidance to, again, optimize. I've been using that word a lot, but what needs to be capitalized. So the case study, the R&D one, we saw that wages were 42% qualified. So, for example, I don't remember the exact numbers, but $1 million in total wages paid by a company. If 420,000 are qualified, then this 42% is what we're talking about. Wages are 42% qualified against their total. That's usually the sort of number or percentage that a CPA might attribute to all these other line items that need to be capitalized in portion. So if we take, you know, building rent, 200 grand, and we slap the 42% allocation on that, all of a sudden, almost 100 grand of that cost needs to be capitalized. And maybe that's not as accurate as it could be. So what we would do within these 174 compliance studies for our clients is identify some other facts that allow for reasonable allocation methods. Maybe the actual portion of the facility where R&D is occurring, like the shop, for instance, and all the other buildings are marketing, administrative, finance. Maybe that percentage is only 15%, and that's completely reasonable to attribute to the building's rent or depreciation. If this is a manufacturing company, most of the work is being done on the shop floor or the manufacturing facility. There's not a lot of phone and internet being used by those personnel while R&D is occurring. So maybe instead of 40% or 42%, we attribute 5% qualified to that line item. Maybe the portion of assets or the ratio of assets used in actual R&D compared to all assets owned, book cost wise, is only 10%. So we take these reasonable allocation methods and we'll go to what that looks like if we change what we're using here. So say we used the bad one, the generic 42% one for all these other line items, the top example. QREs under 41, what you actually get the credit on, you see the 1.5 million, but total cost to capitalize in this example are a little over 2 million. If we just optimize a little bit, spend 5 to 10 more hours getting some data and analyzing what is reasonable that we can consistently apply going forward, we change allocation method 1 to the ones I mentioned in the previous slide applicably, all of a sudden you're capitalizing 100 grand less, which may not sound significant, but definitely would be for some. The implied tax savings on that, if you're like a 30% effective tax rate, is 30 grand, just by looking into how do we do this a little better and more reasonably. So if it's a $10 million manufacturing company, this could easily save you a couple $100 grand in capitalized costs and associated tax. So just to kind of summarize the impact, I know the capitalization requirement is probably new, and this is all kind of educational for some. So if you just comply to the law and the tax rules, which is step 1, that we would never advise not to, this is what it looks like. The important thing to note here is that as you continue to capitalize costs year over year, you're going to be utilizing multiple years of amortization expense at once. They kind of stack up on top of each other. in 2027, you'll have a portion of 2024's capitalized amount being expensed, 2025's, 2026's, so on. So the tax impact, the tax increase dwindles over time. But if you don't claim the credit, you're basically going to get to zero as far as the tax change, but that's it. Now, if you claim the credit as well, which again, totally would advise, there's no reason not to. First of all, the year one impact changes significantly. You get that $150,000 credit to offset tax. Your tax is only increasing $250K versus the previous slide, $400. But also the main thing, you actually flip to tax savings, and cumulatively you also save in tax. Just takes several years, but definitely add the credit in. Compliance is the first step, needs to be followed. It's as if the corporate tax rate increases to 40%. Like, no one's not going to follow that. So if you claim the credit and optimize what you're capitalizing in a reasonable way, basically, if for a few years this hurts a little bit, you start to save money by 2024 to 2026, depending on effective tax rate, and thereafter savings would occur in perpetuity. That's if this rule doesn't go away. So I've alluded to a lot of this, but a couple more notes. We said this doesn't apply to 2022. So the statute of limitations allows for an amendment to claim the credit on 2021. That is still possible. You would take your deductions and the credit in that case. For a company still in losses or still utilizing significant NOL carryforwards, the TCJA also impacted the use of NOL carryforwards, limiting them to only 80% utilization against taxable income in any given year. So if you're profitable, but you have huge NOLs and you think that's going to bring your tax to zero, it's not. You're still going to have 20% of your taxable income in that associated tax. All the more reason to claim the credit. Certain states don't conform. So California, the notable one, at the state level, you claim the credit and you don't need to capitalize those costs. Tax saving, we went over. And the last thing notable is just that, say either you need to bank credits for future use, they carry forward for up to 20 years, and or you're capitalizing and you have those deferred expenses, that is going to increase your valuation for things like loans, maybe private funding of some kind, or acquisitions. So it's not, even with the immediate cash tax hit, it's not all bad in any means.
Okay, so now I'm going to go quickly over this, just a few benefits and why to really get this R&D credit calculation done prior to claiming your tax returns each year. So I'm sure a lot of you guys are already aware of this, but for 2025, if you follow the tax year as a calendar year, your C Corp deadline and sole proprietor deadline is 4/15, and your S Corp and partnership deadline is March 17th this year. And then if you file on extension, it'll be September 15th for S Corps and partnerships, and then October 15th for C Corps and sole proprietorships. So obviously, if you don't follow a calendar year, the standard is 3 months after for S Corp and partnerships, and then 4 months after for C Corps and sole proprietorships. So just keep these in mind as you're going through your year. So a few reasons that it's important to try to get the R&D credit in on an original filing. Obviously, it's an immediate dollar for dollar offset of tax liability. So it's just on your tax return, immediately reducing your taxes. The IRS, as I'm sure you guys know, can take quite a long time to process amended returns. So, instead of waiting for that benefit to come in, you want to make sure that you are doing it on a yearly basis to get that benefit immediately. Additionally, there are some requirements for filing an R&D credit on an amended return. You now have to attach a statement that details the business components and the activities that you sought to uncover. The cost of amending can be high, and then also claiming on an original return can be very helpful when you're estimating tax payments.
And we'll whip through these last couple, but another example along with the attached statement requirements. 6765 is where you report the R&D credit. That's changing both for 24 and 25 tax years. The point of this with the, go ahead and file ASAP, like that's always what we tell clients, is that you never know when further compliance developments are going to come, reporting developments are going to change. The 6765 could be updated again like six months from now. And so, I think there's just filing when you have a grasp on what you need to do before it changes again is the message, and something always to keep in mind. But the other biggest one is just that amending is a pain, it's expensive, and then if you're due a refund, it could at this point take up to a year or a little bit longer.
Awesome. So I want to leave enough time for questions. So I am going to go through Leighton's process pretty quickly, but we did put our Calendly in the chat if anyone wants to have a conversation and learn a little bit more. So we typically have a customized engagement. We'll have a first call where we discuss the applicability of the R&D tax credit to your business, whether you've been capitalizing costs, if that's been optimized, so on and so forth. We'll have some back and forth discussions. Leighton will work on our technical narrative that can serve as substantiation for your claim. And then we'll also work on actually performing the calculation, as we will then deliver our deliverables. So on the technical side, that's an R&D report that's comprehensive of the study, as well as any attached statements required to file the claim if you're amending. And then on the financial side, draft tax forms, any aggregation statements, so on and so forth, will be delivered. The goal is that your CPA will simply be able to copy and paste whatever we give to you into your original filing or your amended filing and be good to go. And then the goal is we do this year over year, since it isn't a credit that gets claimed yearly as long as you're doing research. So we would re-engage year after year to make sure that you guys are maximizing that R&D credit. Here's a few other services that Leighton looks at when we begin talking to a client. So in innovation, we do the R&D credit, orphan drug credit. We also work on research grant applications. We do a lot of the energy efficiency deductions and tax credits. We have a comprehensive suite of SALT services, nexus study, refund review, so on and so forth. Cost segregation, we also work on. And then finally, grants and incentives. So we are able to kind of do a comprehensive landscape of what grants look like for your business over the next couple of years. So here's our last poll question, and then I'm going to start scrolling through the chat to address the questions that have already been asked. But if any of those other services I just mentioned would be of interest to you, please go ahead and mark that in the poll.
Yeah, so Savannah, I'm going to address the one hot one that someone wanted to echo, and it's one we get often. It's will the amortization requirement be repealed? Will it be reversed, etc. No info on this, as a hard answer, none so far as of the new administration. But I would say that there was a lot of momentum on the same sort of concept last year around this time, and it went through the House, and then it kind of fizzled out, and there was no change to the capitalization requirement. The other thing is that, of course, the TCJA was passed during Trump's first administration, which caused all this. So sentiment-wise, like we talked to a lot of other competitors, consultancy firms. Our head of tax has a couple connects at the IRS, and the best answer is like 50-50 chance, but it could take months. Just for the purposes of sending your estimated tax payment out and getting your 2024 filing done, we wouldn't recommend extending just to wait out if it's going to get repealed, because it could happen next year. It could happen in 2. It could go through the House again and not ultimately get repealed. It is more likely, if it's coming from the president, that it will fully be enacted this year, compared to last time. But that's the kind of long-winded answer. And on the filing too, I mean, there's a couple things that might happen if it is repealed. Maybe they allow for retroactive amendments and uncapitalizing what you previously capitalized. But the more likely scenario is, say, the rules get repealed in, during this year, but people have already filed their 2024 returns. They probably will allow for just a catch-up accelerated amortization of the remainder of those costs next time you file. So the worst case scenario is that you capitalize $1 million, you're going to get to expense the remaining 800,000 or 900,000 next tax year. But it is certainly up in the air and not definitive at this point.
So the next question I see that I want to address is, Mike, you mentioned that you claim the credit on can it be claimed on custom made to order prototype costs? So prototype costs generally, as long as you guys are owning that IP, are able to be qualified for the research credit. The custom made question, it really depends on the nature of your business. We would kind of need to know more about what that looks like. If someone is coming to you saying, look, here's the exact specifications, here's exactly what we need you to make, and you just make that, then there's not really any technical uncertainty involved in that. So that would likely not qualify. But let's say you have to do a lot of research yourself, maybe trying different materials or trying different arrangements or processing speeds, whatever that may be, then that technical uncertainty does exist. So for contract manufacturers or kind of contract research organizations, we really need to dig into what those contracts look like with your client, and whether you guys retain any IP to the internal processes that you're using, or if you're improving those internal processes yourself. So I would encourage you, Mike, to get in touch with us. I'm happy to go into more depth and learn a little bit more to see if you guys would be able to claim.
I'm going to answer a couple more, but also just real quick on the other services. It's a really good way to offset the impact of the short-term impact of capitalizing costs, even if you are claiming the credit. So a couple of things just real quick that I think are helpful. For state and local tax refund reviews, if you're doing R&D as a company, then a lot of your purchases in most states should be exempt from sales tax. Purchases on machinery, equipment, utilities, materials, and supplies in conjunction with R&D activities. So we help identify those costs just by looking at purchase reports. And then we also track down the vendors, whether they be private or state oriented, and get those refunds. So that's a great pairing with R&D if you're capitalizing costs and need some cash, along with if you own a facility that recently has been placed into service. 179D clean energy deduction or cost segregation to accelerate that depreciation. We find pretty often that they work well in conjunction with what we're doing here. Go ahead, Savannah. I got to find it again.
Okay. So let's see here. The one that was in the Q&A. So you guys allocate travel, dues and subscriptions, and shipping postage to your R&D department. So if those activities are necessary essentially for the research activities, and Devin, correct me if I'm wrong here, but they would need to be included in the 174 costs. Is that correct?
Yeah. So 174, they actually use the term SREs instead of QREs. So it's specified research expenditures. And part of that is costs associated with discovering information for the intent of research and development. So dues and subscriptions and anything else, again, it's vague, but being used to discover information with the intent of doing research and development should be capitalized, at least a portion, just like the other costs. So same with travel, particularly like if you're working on an R&D project and part of the completely necessary cost of that overall was the travel expenses, then yes, it should be capitalized. It's even with the guidelines and the notices, I certainly kind of a gray area, like what all in needs to be capitalized. And for instance, if the travel costs were flights where for a couple days during that trip, it was R&D centric and focused, but the other 5 days were run-of-the-mill business meetings, then it would be a portion, certainly not the whole cost needing to be capitalized. But there is that discovering information, which is kind of more broad than process of experimentation activities and whatnot, that needs to be considered. So we certainly are not going to get to all of these, but it's a good cause to have a 15-minute conversation with us. But any more jump out to you, Savannah?
No, I was going to see, there was a question, I think, on Puerto Rico.
Yeah. And there's a Puerto Rico based credit. It's up to 50% of your qualified expenditure. That's kind of the Puerto Rico R&D program. And if you're a Puerto Rico based company performing physically R&D in the States, then it's a little more complicated. The short is, yes, there are incentives available within this tax code, but that's something that definitely would be worth a more in-depth conversation.
I would also just lastly, for that amendment requirements, the as of 2021, you have to attach a statement. Originally, they had you break down all of the people that were qualified and essentially detail what activities they contributed towards R&D. However, they recently just released an updated requirement, which now only says that when you claim the R&D credit on an amended return, you need to include every business component that's being qualified and the research that was done, or the information that was sought to be discovered. So, we were trying to determine the optimal pressures, or we were trying to determine the optimal material to use, so on and so forth. And you really have to go through those uncertainties in that attached statement when you file on an amended return. It's not required for an original filing, so it does lessen the burden a bit to get that in on an original book. So I really would love to go through here and address all of these questions. This part's fun. You guys have some great questions, but we will obviously be in touch. This recording will be available on YouTube for all of you guys to watch again. But if you do have any follow-up questions, book a meeting with us. Devin and I would be happy to answer any of these questions more in depth and see how we can either help you guys lower those 174 costs that you are capitalizing, and try to maximize that R&D credit that you guys are either claiming or haven't claimed yet. So it's been a pleasure, and thank you all so much for joining.
Thank you, everyone.